Business editor Peter Ryan, no surprise here today, Peter.
Totally right. Kim on hold at 4.25%. That's where the cash rate has been since December last year, so no surprises at all today. And there wasn't a single economist at all who tipped a rate movement, but as predicted, rates on hold at 4.25%.
Well, I give you a chance to have a look at the Reserve Bank statement in order to try to figure out some of the reasons that the board has given for leaving interest rates on hold. Let's just repeat that interest rates have been left on hold by the Reserve Bank today at 4.25%. Peter Ryan, what's the main reason for it?
It appears to be one of the main reasons that the Reserve Bank is giving that it doesn't see the chance of a deep downturn in the global economy, which makes sense given what the Reserve Bank has been saying in recent statements, that they do feel much more comfortable about the situation in Europe. Remember in December, November last year, there were serious concerns of a potential breakup or a meltdown of the Eurozone. That has come back slightly. We're perhaps going to be getting the best of the worst case scenarios out of Europe. That is a deep recession in Europe. Also, the other side that the Reserve Bank would be looking at is that in the United States, the threat of a double dip recession appears to be unlikely, and economic indicators in the United States are looking much better than they were, although coming off a low base. So given the global outlook and the financial pressures that the world might have been facing, the Reserve Bank appears to be comfortable to stay on the sidelines, watch the global situation and leave rates where they are.
And any effect on the Australian dollar as a result of this decision today?
The Australian dollar's ticked up just very slightly. It was 106.47 US cents before the decision was announced, just 106.55, so up very slightly. That's what we'd expect. The dollar was down earlier today in anticipation of the rates decision, but also after China cut its growth forecast from 8% to what you'd have to say is still stellar 7.5%. So you wouldn't say that there's a pall over the dollar, but investors are being alert but not alarmed.
Now, of course, we always watch the Reserve Bank interest rate decision very, very closely, but what we've seen in recent months is some of the major banks breaking away from locking themselves into this cycle with the Reserve Bank's interest rate movements. And of course, last month, even though the Reserve Bank left interest rates on hold, the major banks ticked up their rates slightly. Do you think the same thing might happen again this month?
Well, it's going to be interesting, Kim, because on Friday, the ANZ Bank holds its own independent interest rate setting meeting, and they announced that late last year that they would do that independently on the second Friday of every month. So it's very timely, only a few days to see what the ANZ Bank has decided to do. Last time around, they were the first to move with an independent 6 basis point increase, even though rates were left on hold. So we'll just have to wait and see what the ANZ does, but it would seem unlikely at this point that any bank would move before they see what the ANZ does.
Indeed. And just a final note, there's some other key economic data out this week, both GDP and employment data.
Yes, well, the big one tomorrow was GDP, expecting that to come in at around about 0.7 of 1% in the quarter. The national accounts were out today, showing a bit of an uptick in exports, added a third of a percentage point to GDP in the quarter. So you'd have to say that even though commodity prices are falling back just a bit, the economy remains strong. The government would remain assured that the pipeline of investments coming out of China would still be there, so the economy is still very strong, and they would feel assured by those comments from the Reserve Bank today about the fears of a deep fallout or a hard landing out of Europe not really coming to pass.
All right, our business editor Peter Ryan, thank you very much for joining us.